What is capital formation in supply-side economic theory? Imagine a bustling factory, machines humming, workers busy, and products rolling off the line. All of this starts with something called capital formation. It might sound fancy, but it's really about turning savings into tools that help businesses grow. In supply-side economics, this process is at the heart of how economies expand and prosper. When people save money, those savings can be used to buy new equipment, build infrastructure, or develop new technology. These investments boost the capacity of businesses to make more goods and services faster and cheaper. Think about a small manufacturing company. If it invests in a new machine, it can produce more products in less time. That means more sales, more jobs, and higher wages for workers. Capital formation makes this possible by encouraging businesses to reinvest profits into new tools and facilities. Policies that support this include lowering taxes on investments and profits, which gives companies more money to spend on growth. When taxes on capital gains and corporate income are lower, it's easier for businesses to keep more of their earnings and put them back into their operations. From a conservative viewpoint, especially among Republicans, capital formation is seen as a key to economic success. They believe that when the government reduces taxes and regulation, it creates a friendly environment for businesses to invest. This leads to more innovation, more jobs, and higher wages. They argue that the best way to grow the economy is by encouraging private investment rather than relying on government spending or demand-side measures. In practical terms, this means policies like tax cuts on capital gains, investment tax credits, and fewer rules that make it harder for businesses to expand. These measures make it easier for companies to buy new equipment or expand their facilities. The goal is to increase the amount of capital available for investment, which then leads to more goods and services being produced. As a result, the economy grows stronger, more jobs are created, and people's living standards improve. So, in simple words, capital formation in supply-side economics is about turning savings into investments that help businesses grow. It's a way to boost productivity, lower costs, and create a thriving economy through private sector effort. This approach aligns with core conservative principles of free markets and limited government intervention, aiming for long-term prosperity driven by private investment and innovation.